Suddenly, a chunk of your salary disappears and you wonder, where did all my money go? If you are a salaried employee, you will have faced this in January, February, March if you haven't planned your taxes well. What if I tell you a well-planned tax saving strategy can lower your burden of taxes and help you build wealth? Tax saving is a tedious process for most of the working profession. When your CA or accountants bombards you with terms like new regime, old regime, section 80C, section 80D, section CCD, or deductions for home loan, education loan, it all goes bouncer. I'm sure that you have experienced this at least once in your lifetime. In this video, let us help you break taxation in simple terms and plan to save your wealth from your hard-earned money. Stay till the end because you will exactly know how to plan your tax-saving investments, the biggest mistake people make while tax planning, and how you can avoid them. Do subscribe to our channel to learn, adapt, and grow as a better investor. Namaste, I am Rohini and welcome to the knowledge series of Fincash.com. The new tax regime was introduced in 2021 and it is getting updated every year. Even in 2025 it got revised. But is it better than the old regime? Which regime is ideal for you and which regime will help you save more taxes? Let us find out. The tax slab for old regime and new regime for the financial year 2025 and 6 are visible on your screen now. Both the new and old regime has its own pros and cons. Let us understand about it through this live example. Sachin earns 10 lakh rupees. Let us see how much he have to pay under both new and old regime. Under the old regime, the standard deduction is 50,000. Sachin can save up to 1,50,000 under section 80C by making investments in ELSS, PPF, LIC. In health insurance, that is 80D, he can save up to 50,000 for himself and his parents. Under employment contribution to NPS, that is 80CCDB1, he can save up to 50,000. In HRA, he can save up to 2,50,000. So the total taxable income is 4,50,000. So tax payable is nil. Under new regime, the standard deduction is of 75,000. There are no other deductions. So the taxable income is 9,25,000. Taxable payable is 0. So practically nil taxes, but Sachin invested 2 lakhs under old regime for his future. Let us see example 2. Suppose Asha is earning 15 lakh. Under the old regime, she gets a standard deduction of 50,000. She can save up to 1,50,000 under ATC investments. She can save up to 50,000 in health insurance, 3,75,000 in HRA, 50,000 in MPS. So the total taxable income is 8,25,000. Under old regime, the tax payable is 80,600. Under new regime, the standard deduction is of 75,000. There are no other deduction, so the net taxable income is 14,25,000. Asha needs to pay taxes of 97,500. Let us take third example. Suppose Ram is earning 25 lakh. Under old regime, he gets standard deduction of 50,000. He makes 1,50,000 investment under ATC. In health insurance, he get deduction of 50,000. In HRA, 6,25,000. Under NPS, it is 50,000. So the taxable income accounts to 15,75,000. Ram needs to pay taxes of 2,96,400. Under new regime, the standard deduction is of 75,000. There are no other deductions, so the taxable income for Ram is 24,25,000. So he needs to pay taxes of 3,19,800. If you are a person who likes to invest for the future, the old regime is best for you. The new regime does not encourage disciplined investment. Although in old regime, the investment may look forced on you, but your hard-earned money will earn for you in the future. Under new regime, you have only one option, that is standard deduction of 75,000. But in old regime, you have broad categories where you can invest money to save your taxes. Under section 80C, you can invest up to 1,50,000 on which you will not have to pay taxes. You can invest in ELSS, that is Equity Linked Savings Scheme. These are market linked mutual fund with a lock-in period of 3 years. ELSS has historically delivered average annual returns of 12 to 15% over the long term. This makes an ideal choice for wealth creation and tax savings in one go. Public Provident Fund, that is PPF, is a guaranteed interest rate which is revised quarterly. The current rate is around 7.1% per annum with a lock-in period of 15 years. The best part is both the interest earned and the maturity amount are completely tax-free. The third option under ATC, NSC, National Savings Certificate, offers a fixed rate of 7.7% as of financial year 25-26 with a tenure of 5 years. With the interest earned in taxable, the principal investment qualifies for deduction under ATC. You have NPS, that is National Pension Scheme, which allows deduction up to 1.5 lakh under section 80CCD1. Additionally, you can claim an extra 50,000 deduction under section 80CCD1B. NPS is specially beneficial for long-term retirement planning. The other option you have is fixed income life insurance premiums. The premiums paid for life insurance policy are eligible for deduction up to 1.5 lakh. Whether it is term plan, endowment policy or ULIP, life insurance serves as both a safety net and tax investment, making it a wise addition to your financial plan. The plan varies according to companies, so please go through the fine prints before investment. Under ATD, you can claim deduction of up to 25,000 for health insurance premiums covering yourself, your spouse and your children. You can increase the deduction limit up to 50,000 by paying premiums for your parents who are 60 and above. Health insurance provides a financial shield in case of medical emergency, a win-win for your health and finances. You have another option under section 24B. If you own a home with a loan, you can claim a deduction up to 2 lakhs annually on the interest paid, and you can claim section 80C for principal amount, and you can double this tax claim by taking a joint home loan if both married parties are working. This is a significant advantage, particularly for homeowners with big size home loan. You have another option, that is interest on second home loan. It is fully deductible without any cap if it is rented out. If the second home is self-occupied, the interest deduction limit is 2 lakh per year. For a high net worth individuals paying 10 lakh in interest annually on a rented property, this can translate to a tax saving of approximately 3 lakh if taxed at 30% slab rate. You can claim deduction on education loan, that is section 80E. If you have taken an education loan for yourself, your spouse, children, or even a student from whom your legal guardian, you can claim a deduction on the interest paid on that loan under section 80E. There is no upper limit on the interest paid you can claim. Deduction available for up to 8 years or until the interest is fully repaid, whichever is either. Another option you have is house rent allowance, that is HRA. But it depends on factors like basic salary, actual rent paid and city of residence. Ideally, 25% of your salary is HRA. In metro cities like Mumbai, Delhi, Bengaluru, Chennai, the deduction is of 50% of the basic salary, and in non-metros it is 40%. Tax planning mistakes are more common than you think. Here are top ones that you should avoid. Number 1, starting late. You miss out on major chunk of returns if you invest at the last moment, that is in the March end. You tend to lose the entire year's returns. Please do remember, ELSs and other market links gives you better returns only when you invest for the long term. So explore options like systematic investment plan and start investing right at the financial year. Second is investing just to save tax. It is like buying a car and keeping it in a garage. If your investments are not earning for you, why to invest? Always check if an investment makes sense for you for the long-term aspiration aligned with your personal goals. Third is ignoring liquidity needs. When you plan investment for the last minute, your liquidity suffers. Life is unpredictable, whether it is a medical emergency or sudden expense. If your money is stuck in 15-year PPF or 5-year NSC, accessing it becomes difficult. Ensure you have a mix of liquid and long-term investment. Fourth is not reviewing existing investment. We often follow a set it and forget it approach with investment. But are your funds performing well? Is your ELSS funds still giving competitive returns? Have your life circumstances changed? Regularly reviewing and rebalancing your portfolio ensures your money works harder for you. The final and the most critical is picking up wrong tax regime. Many people simply choose new regime thinking it is simpler without calculating which one will benefit them. A simple calculation between both the regime will save you on thousands of your hard-earned money. By avoiding these 5 major mistakes, you not only save on taxes but build a strong financial future for you. Tax season isn't a burden. It is your biggest opportunity to save taxes and grow your wealth. Every rupee saved in taxes is rupee earned, whether you follow old tax regime or new. Smart planning ensures that your hard-earned money works for you. Without proper planning, you end up paying more than you should. But by making right moves, that is, investing in right option, claiming deduction, and structuring your income wisely can reduce your tax liability. The key is not to see tax saving as last moment task. It is an year-round strategy. The more early you invest, the better returns you can unlock. It is your money, invest it smartly.